Welcome everyone, and thank you for being here. This is the kickoff of Managing Egos in M&A, a real world series where we talk through what it actually takes to find, buy, and run a business the right way. I'm your host, Tom Dillon, the owner and operator of Frac Finance, where we work with operators, searchers, and acquirers to get deals done and run tighter businesses post-close. I've been on both sides of the table, raising capital, negotiating terms, dealing with legacy owners, and stepping in post-close when the handoff actually gets real. I created this series because there's too many deals that were falling apart for reasons that have nothing to do with numbers. So this isn't your typical acquisition talk. We're going to cut through the fluff and we're going to get into the real challenges: ego management, owner psychology, legacy issues, team dynamics, the human stuff that really makes or breaks your deal as you're going through your negotiation. So the series is about more than just, again, finding the deal. It's about managing the people and the egos at every stage, because in M&A, the numbers do matter, but the people make or break the deal, and M&A is a dance. Most people have two left feet. So over the next 10 episodes, you're going to hear from seasoned lenders, investors, legal pros, former owners, and operators who have been through this. We'll break it into three clear phases. Phase one is the search and LOI. This is how you approach owners, lenders, structure deals, and beat the competition. That's the one we're in today. Phase two is the due diligence, financial and legal traps, PSA red lines, and negotiating with confidence. And then phase three, arguably the most important one, the transition and execution. Taking over, building trust, aligning culture, and driving growth, of course. So you'll leave each session with tactical tools to help make a difference between a deal that works and one that's going to eat you alive. So whether you're new to ETA, actively searching, or already operating, this series is truly built to sharpen your edge and help you close and run a team with confidence. Let's dive in. So, what are we going to learn today? We're going to go back to the basics. We're going to talk a little bit about the qualitative and the quantitative aspects of this M&A dance. You're going to come away with expert knowledge to really make your journey successful, because this truly is a journey. And ultimately, it's really the what to do and what not to do. So with no further ado, I want to introduce our guest. He has been directly involved in closing over 300 million financing deals across the nation, ranging from self-storage ground up, new construction in Alaska, to private equity platform add-on acquisitions. I'm excited to introduce Matthias Smith. Welcome.
Tom, thanks for having me. First and foremost, I hope I don't get eaten alive and that anyone else in this call does not get eaten alive. That was definitely a very exciting introduction, but no, I'm excited to be a part of your webinar and talk M&A and SBA financing. Thank you for having me.
Absolutely. Matthias, tell us more about you and your team. What it is that you do and who you do it with to set the stage for everyone on the call.
Yeah, absolutely. So what Pioneer Capital Advisory is, Tom, is we are a commercial loan brokerage firm that's focused specifically on SBA financing, more specifically SBA 7A financing, for people that are buying small to medium-sized businesses across the United States that are looking for financing to do so. And our specific area of focus is searchers or business buyers that are looking for financing between $1 million from the SBA 7A up to $5 million, and then some that are buying businesses that need a higher debt quantum amount, where the bank will do SBA plus conventional financing over the top of the $5 million. And so, Kev, essentially the service offering is helping business buyers or searchers navigate through the very fragmented SBA 7A lending market that's $31 billion of originations every year, with banks ranging from Live Oak Bank to Huntington Bank and many others, where each of these banks have defined strike zone or criteria. And the question is, when it comes time to having an LOI as a buyer, where do you ultimately go to pitch your deal? And how do you get from start to finish as quickly and efficiently as possible with minimal friction? And that's where we come into play.
That's awesome. I would love for us to get into a little bit of what the process truly looks like in more granularity if you're open to diving deeper here.
Yeah, of course. So our process, so we typically get involved on a deal with a searcher or buyer, if searcher, just the colloquial term, at the point in time when someone has a signed letter of intent and basically they've defined what the terms are that they're planning to transact on for their business acquisition. And so the process working with us specifically kicks off with an engagement letter that gets sent from my chief operating officer, Valerie Stash, who was on that org chart slide before. And basically the engagement letter explains that my team, Pioneer Capital Advisory, will be helping the searcher or buyer go from start to finish, or A to B, through the SBA financing process, putting together a deal deck that has the sources and uses for the deal that they're looking to buy, the debt service coverage summary, the cash flow analysis. We pull an industry kind of overview as well as the SBA default data or risk for the specific deal from a tool called Lumos Data, which is a financial SaaS software founded by the former CFO of Live Oak Bank, this guy named Brett Keynes. And then we also do a short analysis that has a description of the background of the buyer and the connection between the buyer's skills and experiences in the industry and what makes them ultimately good credit risk. The engagement letter includes a NDA that explains that anyone that we're receiving information from, we keep their data confidential. It only ever gets shared with the SBA banks that we work with, and then whatever specific parties get authorized. So, for example, the buyer's attorney, financial due diligence provider, etc. That's something that we keep very seriously. And then the last kind of caveat in the engagement letter is it gives us exclusivity to broker the SBA financing for the buyer. So we only get paid by the bank at the very end of the process after closing. So unlike the, fractional CFO, financial due diligence provider, attorney that's kind of billing all along the way, we're in the deal process kind of from start to finish with the buyer, and we bear the whole transaction risk with them. And so basically that's kind of a mutual commitment of sorts that if we're working with them as a client, they agree that they're not simultaneously pitching their deals to other banks. So for example, right now we have a deal that's taken 4+ months and it's taken some twists and turns, and like if it dies, we'll get $0, and that's fine because that's how the business model is structured. But once the engagement letter gets signed, at that point in time, we send an intake list to the client that has everything that we need to get started. So basically, business financial statements, tax returns, interim financial statements, personal financial statement for the buyer, buyer's resume, something showing the current credit score to help with positioning the deal well to banks, and then also their last series of tax returns, broker listing for the deal, signed letter of intent, and then the inputs for what amount of working capital the buyer wants to have in the source and use of funds, as well as what they're ballparking for their legal and financial due diligence. Once we have those inputs on, within 2 business days, 3 business days maximum, our analyst has the deck built for the client that ultimately goes to the banks to pitch for term sheets. Then from that point forward, within 3 to 5 business days, typically term sheets come back from which the client has options to decide. And at that specific point, once the client has a business plan done and a 3-year financial projection, that's when the underwriting process would start. And to get from the start of underwriting to closing, it's typically about 74 days, give or take, with us. But I'll just pause there.
No, that's great. I think that really sets the stage well in terms of the process and the technical components of how the deal tactically gets done and what the time horizon looks like on that front. It makes a lot of sense. So do you want to touch a little bit on these aspects? I know this is more the documentation, but perhaps it's helpful just to, I know we talked briefly about these already.
Yeah, so this slide, Tom, is basically just the intake list of the inputs of what we would need to build the deck for the banks. Generally speaking, shortly after going under signed letter of intent, most clients would be able to get the business tax returns and interim financials in pretty short order. So most of the stuff on this list, normally speaking, doesn't take a whole lot of time to pull together. The 2 items not on this list that would be needed post getting financing proposals but before underwriting kickoff that tend to take time are going to be the business plan and the financial projection.
Okay. That makes sense. And so this is kind of the more specific timeline on how you guys arrived there. What delays this timeline?
Yeah, typical things that delay this timeline, I would say, is generally business plan, financial projection, the data room not being super organized. So sometimes when we start working with someone, we might have bits and pieces of different things where, generally speaking, Tom, it's when there are multiple people that are in the buyer group. So let's say that me and you are buying an HVAC company together. Maybe I'm a full-time searcher. You're keeping your job at wherever you're employed, and you're kind of slower as a result to pull together items into the data room that are needed for the banks. That's where I typically see things kind of slow down. Other than that, I would say typically it's due to questions specific to the business that's being financed. So let's say, for example, the company being financed, the cash flow hinges a lot on add backs, and maybe the company is selling for a multiple of the last year of earnings or the trailing 12 months. So the last 12 months, and the bank really needs to get comfortable with what the add backs are before they want to put pen to paper and issue the financing proposal. Those are a couple of the things I would say can delay the onset of the underwriting process.
Could I ask a question, Matthias?
Yeah, go for it.
So the business plan, right? Is that something that the buyer has to put together? Is that right? Or do you guys help with that, or how does that work?
Yeah, great question, Naveen. So the business plan, there's kind of a menu of different options, if you will. So we have templates where we give them to the buyer if they want to take a swing at it themselves. There's also a company that I have equity in that's an affiliate of Pioneer called S&B Business Plans, where I have an operating partner named Joe Thomas that helps with those. Or if people want to use, there are some of these AI online business plan tools. I think one is called Live Business Plans. I've heard phenomenal things about that. And then there are some others too. I know some people use ChatGPT or Claude or some of those other things as well. So the biggest things, candidly, Naveen, is whatever the output is for the business plan, you want it to really do a good job at articulating, one, what does the company do? What does it sell and what's the offering? What does the current organizational chart look like? Basically, who does what in the business? How involved is the seller individually in this company? And helping the bank understand very well, if you pull this seller out of the business, will it continue to run well, or is it going to lose oxygen? And then how do you as the buyer plan to change things after you take control of this business? And then explaining kind of other big things like, one, especially now, is supply chain. So not to get political, but with all this stuff going on in the broader economy, really helping the bank understand the inputs of, raw materials if you're selling a good versus service. And then also things like competition similar, if that helps.
Yeah, that does. So you want to get all those details, the org chart, the source, the supplies and things like that. You want to get that from the seller so that you can put it in your business plan, right?
Yeah, and generally too, Naveen, a lot of these inputs will be in the broker listing. If you're, not to give a show for Tom here, but if you're working with a good sell-side M&A broker, like Tom, who has another business he's involved in, that can definitely be helpful. But I'd say if you get those inputs earlier in the process, and if you're super Johnny on the spot or Jay on the spot, and you have the business plan before the deal gets pitched to the banks, that helps get questions of the way that they're going to ultimately come back to you with.
Got it. And the other question I had is
giving them the answer to the question before they have it.
Right. Got it. The other question I had is, could you talk about the seller background, due diligence and stuff? Like, I know most of the sellers, like 80% of the sellers buyers don't actually have background in the industry that they're buying in, right? So how do you address that? Or, is that an issue, or could you talk about that?
Yeah, so I would say there, Naveen, to the extent that you can communicate that you've overseen people to some degree and or had some P&L oversight, that goes a long way. Now, the analogy I'll kind of give here is, like, to your point, not everyone has direct experience with the company that they're buying. And so similar to being in school, if you have a background going to college or high school, et cetera, and you're writing an essay and you're trying to hit the thesis, the thesis basically in these business plans is that I myself, Naveen or Matthias or Tom, am the right buyer for this business. And so that's the thread that you're trying to pull along the way in the business plan. And so you're going to have some type of thing from a professional background standpoint that's transferable. And it's just how do you basically get the bank on board of that, if that helps.
Got it. So that's all you'll need to do. You don't need to show direct experience in the industry.
No, I mean, it definitely helps if you have it. It
Sure.
certainly hurt, but it's not common typically that people have it.
Got it. Yeah. Thank you.
Yeah, great questions. We'll touch on some of that along the way, but let's just take a step back real quick before we get into the players that are kind of on the dance floor here, if you will. I would love to set the stage in terms of what the market looks like before we dive into the players specifically and some of the puts and takes along this path. Matthias, what have you seen lately? I mean, you've closed hundreds of millions in deals. What's the biggest shift that you've seen in the ETA space over the past few years? And is it harder for this searcher to be building trust with sellers?
Yeah, so I guess just to preface on the first comment. So since starting Pioneer, I've only closed 87 deals. So the hundreds of millions of number, that includes working at banks prior to Pioneer. So the biggest shifts I've seen, Tom, candidly, has been the number of entrants to this market relative to the last 2 to 3 years. So back when I started Pioneer, as far as conversations I was having with buyers, many of them were coming from the classic, investment banking, private equity, consulting, and almost kind of business school type background, because that had really been the classic search profile. And people kind of branched away from just wanting to do the traditional search to doing the self-funded, coming from those same types of backgrounds. But now you have, everyone from, right now I'm working with someone coming from a corporate desk job at a very established retailer, like you'd recognize the name of this company, and just people from all across different backgrounds, moms that had been staying at home buying businesses, all different types of people. And so it's just becoming a lot more crowded as a whole. And I would say as it's become more popularized, the types of companies that had been trading before for lower multiples, all of a sudden now you're seeing those sell for higher multiples, and just there being more buy-side competition on the same deal than there used to be before.
That makes sense. And I guess from your perspective, how do you see, clearly that the dynamic in this lower mid-market has changed with private equity, the funded searchers. How have you seen people effectively compete against some of these more, I'll call them institutional type players?
So the biggest thing I would say as a whole, kind of to preface, is when you're a searcher kind of using SBA financing and not a private equity company, one of the biggest distinctions that you can really draw on is that you're presenting the seller with a different deal fundamentally using SBA financing than you would if you're a PE firm. So if you're using private equity funds to buy a company, generally speaking, the seller is going to stay on for a specific period of time. There's going to be an earnout structure where they'll get exit closing. They're typically rolling equity. And then if certain milestones get hit, they can get more. And so there's more unknown for the seller as to what their final economic outcome will be, even if the top line number is a higher one if you're a PE firm than if you're a searcher. And so I would just kind of preface there initially. But back to the question, Tom, I would say up until recently, one of the biggest things has been buyers using kind of the creative rollover seller equity structures that the SBA still technically allows, albeit a seller now has to personally guarantee the buyer's SBA loan going forward after June 1st if you want to use that structure, where essentially, so between 2023 and 2025 or June of 2025, just to kind of draw a line in the sand there, if you're looking to pay more for a business to really bridge a valuation gap, you could have the seller roll equity because you could get bank financing up to the point where the valuation of the company was. And then the gap you could fill with rollover seller equity, buyer equity, and seller financing. And so basically now, as far as different creative ways searchers can win from a deal standpoint, I would say the biggest thing is just having alignment with the seller on knowing what their objectives are. If it's just to have a clean exit and it's more about just the top line number that they're going to get closed, or two, if it's someone that's willing to potentially risk share with you. So right now I actually have a couple of deals going where the seller's rolling equity and personally guaranteeing for 2 years. I'll just pause there in case that helps.
Yeah, that's very helpful. And I see some questions coming in the chat. Keep firing those away. We'll address them here shortly. We got a couple more things to get through, and then we're going to open it up for live chat, which I'm super excited about. All right, so now that we've set the stage in terms of kind of the market, some of the rulings that are changing that are going to kind of shape the way in which people are going to approach these deals and try to leverage their advantage, if you will, or disadvantage in whatever way that kind of plays out. The competition is clearly steep, and to really perfect this M&A dance, you need to really understand that it's about the earning trust. And so you have to realize you're being interviewed, right? The seller's handing off the baton, you're being interviewed. And so I'd love to talk about the owner psychology as an aspect here, as one of the largest players in this dance, and kind of what is the first thing that a business owner really wants to see from a buyer before you're even taken seriously?
Yeah, so I would say a couple of different things, Tom. So one is, credibility. So establishing yourself, one, as a credible buyer, whether that be from an experience standpoint. So if you're coming from a background in corporate America, and maybe you've been a team leader, you've had direct reports, whatever kind of assurances you can give the seller that you're actually, a credible buyer, one, from actually having leadership skills, that goes a long way. Two is really kind of back to the first point here about respecting the legacy. One of the biggest fears that many of these sellers have is that you're going to have private equity come in, they're going to gut the company, they're going to lay off employees and things of that nature. And the legacy that the sellers worked for so long to build, even if they get all this money at closing, is going to be tarnished. And so to the degree that you can really explain to the seller, what is your plan as the buyer after closing, after acquiring this company? Are you going to keep things at steady state, or are you planning to add people? What are you planning to change? Some sellers, candidly, and I've seen this before, honestly, recently, like they just don't really care. Like there are sometimes people that are selling in their 30s and 40s, and they just want a financial exit. And after that, they could really care less about the company. But if you're buying from someone that's a baby boomer, where they've been running this thing for 15, 20, 30 plus years, they don't want things to just go sideways after they sell the company to you.
That is a great aspect that you shared right there in terms of the owner demographics, if you will. That's awesome. That's great perspective. What's something you've seen a buyer do right that immediately builds trust with these owners?
Yeah, so I think lots of these sellers, especially the baby boomer types, they like in-person meetings, meeting with them, their spouse, going out to having a meal, sitting down together is huge, and really trying to understand. So back before answering this question, Sam, one thing I think a lot of people that are buying these companies get wrong is a deal is not about you as the buyer. It's ultimately about the seller, because it's about, how can I preserve Tom Dillon's legacy or Naveen's legacy? And to the degree that you can really articulate that well when you're presenting your LOI and getting basically having the seller understand that you're planning to kind of take care of their baby to the degree possible, that's going to go a long way for most of these people. I would say one thing is like just the human element. So even going back to the searcher websites that some of these buyers put together is, they'll have a background themselves. Maybe you come from a military background, or maybe you played sports, and it really kind of presents you as a human. It has a picture of you and your family, maybe your dog or your cat, I see sometimes, and just making you seem like a relatable person. That's one of the biggest things. What really scares lots of sellers, candidly, is just the private equity transactional feel that some of these buyers have coming into the space, where they make it all about, if like the contingent or forgivable seller's notes, where like the moment you start diving into transaction specifics before you can really connect the seller, that's when it gets kind of more edgy, I'd say. One of the hard parts, candidly, in this whole process is that with the number of buyers in these deals and with so many of them being brokered, the broker really is the gatekeeper between the buyer and the seller. And so really being able to pitch the broker, I would say, as the buyer, that you're, one, financially qualified, and two, you plan to protect the seller's legacy. Those things kind of go hand in hand. And I would say when you're pitching the broker, whether it's working with myself and my team at Pioneer to get a financial letter of support, or working with a bank directly to get the same, to kind of articulate that you have the financial standing to buy this business, and that kind of gives credibility of the gate. I think those go a long way. I know I'm kind of rambling here.
No, that's helpful. That leads right into where we're going, which is really now the last player. We have our buyer, our seller here on stage, and it's really now about the lender. You've worked with countless lenders, Matthias, and having strong relationships with them is incredibly important. It's one of the most important things, not just to the seller or to ultimately, the seller. It's their capital source as well. Is this deal have a propensity to close or not? And so we touched on a lot of this stuff already that I wanted to make a point to have you talk about with regards to the business plan, the pro forma, all that good stuff. Maybe just talk about what's like the one thing that you think the lenders are really evaluating when they're looking at a searcher, and then also coupling on that one, how important is it that these searchers understand, or anyone looking to buy these businesses understands their debt obligation and what debt service truly means?
Yeah, so I would say, as far as the lender evaluating the searcher, Tom, there's some nuance involved where the lender is kind of looking at, based on how far you are along in your professional career, there's some discernment when it comes to the personal financial statement. So if you're 5 years into working in the professional work environment, you're typically going to have a lesser net worth than someone that's in their 40s or 50s. But I would say experience is key. So what professional experience do you have, and how can you articulate that in the business plan? So back to point two here. So some people can, based on their backgrounds, they might have been in the military, and maybe they don't have experience in operations at a company, but they've led people in combat or similar, and or maybe they manage people at Amazon or at Walmart, and they can somehow connect that to leading a team in an SMB. I'd say that's huge. To the degree that you have good credit, so like most banks that I work with, typically 680 is going to be the floor. Some will go lower, but it gets hard from a financing standpoint once you fall below that line, as well as just having really good post-close liquidity. So the biggest advice I can give to anyone on this webinar, Tom, is to just save as much as you can and to bolster your cash position in your taxable stock position, because banks want to understand, if we're lending you, Tom, or Naveen or Tanya, millions of dollars, what have you done before to show that you're a good credit risk to us? Because maybe you haven't operated a company, but you've been a responsible person from a credit standpoint. You've obviously accomplished in your career, you've been promoted. They're looking at different variables that they can use to draw on almost from an investment decision to make the discernment, is this a good person to lend to?
Those are great tactical advice points there, Matthias. Thank you for sharing that. Now I'd love to talk about some of the mistakes. We've all made mistakes. I'm sure you've seen your handful, perhaps even made some yourself. And I think it's really important to, when it comes to experience, to kind of lean on those mistakes and learn from them. And so you've learned, I'm sure, from past things that you've seen, whether it's at your old firm, this firm, what have you. And I would imagine you handle them differently today, which makes having you in your corner as a searcher so valuable. Can you give me and give the audience maybe a little bit about a horror story, a deal that went sideways that perhaps shouldn't have and now would be done differently?
Yeah, so without going into too many specifics, so one of the clients I worked with, the business he bought, essentially he increased the sales commissions massively for the employees in the workforce, and essentially he got himself into the deal with a transaction structure that, essentially myself, the lender, myself and the QV provider didn't necessarily recommend. And so now he's leveraged pretty highly and he's in a little bit of a pickle trying to work with the bank to get through a bit of a slow period of time. And so what I would say kind of broadly, Tom, is a theme to anyone on this call that's looking at buying a business, whether it be with SBA financing or otherwise, is really try to dive into the working capital dynamics in the business that you're buying and understanding what the appropriate amount of working capital is. So look at, what are the operating expenses on a monthly basis? Is this company gonna have a big cash burn after you buy it, especially if you're looking to change things? Does this company normally have a line of credit? If so, what's the seller typically drawing on this thing? And understanding things like accounts receivable, accounts payable, how long does it take the business to actually bring cash in the door from the time a sale is generated? And basically kind of drilling down the three fundamental ways of capitalizing a deal. So one is getting the seller to leave working capital in the actual purchase price of the business. So cash, accounts receivable, and inventory too. The more liquid, the better. Also understanding how much working capital you think you need from the bank. So most of these SBA banks will finance working capital into the acquisition structure up to the amount of the down payment that you're putting in, if you can justify it. And then also getting a line of credit. So most of these banks, not all of them, will provide what's called an SBA Express line of credit that goes up to $500,000 maximum, where typically the first 3 years after closing, you can draw on it up and down, kind of analogous to home equity line of credit. And then the subsequent 7 years, it amortizes out based on the amount drawn. And so what I tell people is always try to get the line of credit. And if your deal is structured in a way that you can't find a bank that will provide the line of credit, it's probably structured too aggressively, because the more conservative and middle of the road camp of banks will provide those. And then pick at least one of the two options of ways to get working capital into the deal, from either getting it from the seller at closing, including the purchase price, or getting it from the bank.
That's really helpful. What's a subtle red flag that you see kill more deals than people realize as they're new to this?
Yeah, I would say red flags. Can you elaborate on the question just so I can make sure I answer it correctly?
Yeah, so like someone that is approaching, and this is more about the lender. So think of it as a searcher going to a lender, and they don't realize that this is going to be a red flag for the lender. And they might just not even think anything of it because it's typically pretty subtle. And I'm trying to see if we can have people avoid that as they go forward and work with you, approach lenders.
Yeah. I would say, okay, so a couple of red flags. One is in the pitch, like to banks. So sometimes people they're pretty aggressive. So whether they're reaching out to me or they're reaching out to Bruce Marks at First Big the Lake or like Lisa Force at Live Oak Bank, is you can just tell from like the tone, just in the initial email, how someone will be from a personality standpoint. And so I would say just from that standpoint, like, you have a signed LOI, everyone's excited for you, they want you to win, get your deal done. Don't sound like you're all about, the best interest rate or whatever, even if you are of the gates, and like sound like when you're talking to the banker, regardless of who it is, that you like, you're genuinely interested in working with them, because the top lenders have lots of inbound, and like certain things can turn them off. And once you can't come across confrontational, it's hard to undo that because they've made their opinion about you. I would say other things are like I've had people before that have reached out to me where in their like one pager on their search fund it talks about wanting to buy 7 companies a year and doing a massive roll-up strategy and things of that nature. Like that kind of makes it seem like you're on the same planet as the bank typically, and then just other things similar to that.
That is great tactical advice. I think, yeah, certainly the crawl, walk, run approach is definitely going to be a more believable ambition plan. It's great to have ambition, but you definitely want to approach with caution in terms of what's realistic as well. So I love that. All right, so Matthias, you help people stand out from the crowd. You have been doing this for a while. You obviously have a playbook of success that works. Can you help, before we jump into the live conversation Q&A, can you just give some of, advice around what makes someone worth betting on, and maybe talk about, again, that experience versus business acumen that doesn't necessarily play into effect the psychology that these buyers are worried about might happen with regards to the conversations that are going to ensue?
Yeah, so I would say as far as like, so with the first bullet points on, as far as what banks look for a searcher, because what I look for, honestly, doesn't really matter. I'm not the one putting these loans. But as far as what the banks look for the searcher, I would say one is someone that's just credible, confident, they're pragmatic and measured, and they seem like they're commercially reasonable to work with. The biggest fear banks have, candidly, is like, one, the whole bet of the financing, or much of it candidly, is on you as the buyer. And so one is on like, how sharp and astute are you from a business standpoint? And are you someone that's coachable? Are you teachable? Are you gonna be a sponge? If you need to get a business coach, or are you someone that's willing to seek advice and actually listen to other people, pulling in fractional CFOs and similar? And I'd say just one is just like, will you be enjoyable to work with? Are you a sharp person, which is very subjective? And, are you pragmatic? I would say another thing is, how are you thinking about this actual business? So, a lot of people get excited about the actual numbers of the company, which makes sense. But do you see this company as one that's growing? Do you see this as something that's kind of plateaued, and it's basically kind of at the peak from an earnings standpoint? Maybe it's in a market that's kind of recessing a bit, so you have to kind of look at the actual macroeconomy. And basically, what is your thesis specific to this business? And how can you explain to the bank, well, that you've done enough research on this actual company to be able to, one, know that this company itself is viable, two, that it's going to actually continue to grow and do well in the market that it's in, and then three, that you're the ultimate kind of right buyer for this business.
That's awesome. Well said. All right, before we start taking questions, what's one piece of advice that someone has given you either in the past or recently that has really stuck with you and has helped you be successful in this M&A game?
Yes, I would say, advice that I've gotten that's helped me be successful, I would just say it's all about repetition. No one is going to close. So I admittedly, at the time, I've never, tried to buy a business or gone through this myself, but just speaking from the aperture of people I've worked with, it's all about repetition. It's rare when someone's going to get their first LOI to the closing table. I'd say LOI 3, 4, sometimes 5 or after is when people ultimately transact and get a deal done. And the best thing that you can do is just try to stay positive, which I know sounds super corny. Try to avoid incurring costs on the legal and diligence side until you're far enough along that you feel like you actually have a deal in hand. One thing I actually tell lots of buyers I work with is to start with the IOI, or the indication of interest, before the LOI if the broker and the seller are willing to entertain it. The specific reason why there, Tom, is that in the IOI, you can basically try to determine and ascertain, are you and the seller actually on the same plane in the same field? as far as things go with valuation and general deal structure, whether it's seller financing, provisions on things like how long they'll be around for consulting or similar. And the more that you can suss that out on the front end before you pull in the attorney, the QV firm, and similar, the better off you're ultimately going to be.